A lot happened this week. You see Jerome Powell, the Federal Reserve chair, saying he's going to hold interest rates steady, indicates 3 rate cuts in 2024. This caused risk assets to explode higher. Folks are excited about lower interest rates. You see NASDAQ up over 50% year to date, and even more speculative and sensitive investments tied to interest rates like Carvana, which is tied to used cars, the consumer, and financing, for that consumer. That stock is up nearly 1,000% year to date. So once again, this is giving a caption that, hey, the consumer is not going to fall apart. Interest rates are not going to go crazy high, and you don't have to worry, about what that impact will be on everything that's tied to financed purchases like cars. And so saying, hey, things will be fine. That's this 1,000% rally year to date in a stock like Carvana. And it's partly because the underlying fundamentals are pretty good. For example, you look at inflation. By some analyst estimates, it's now trending below the 2% target. So if you can get it below that target, maybe you can cut rates even faster. And here's a note from Goldman Sachs saying, look, the faster we return to a 2% target means faster cuts. Faster cuts, that's even better for risk assets. Lower interest rates, hey, valuations can expand. And then you get a little juice in the economy as well, and the economy is already running hot. Isn't this wonderful? And this is a take from Goldman Sachs here. You have Docusign, DOCU is the ticker. They look at this speculative window and they're saying, okay, maybe now's the time to take advantage of this. And you see the news that they're saying, hey, let's explore a sale. If you go on their website, you don't see a formal announcement or anything like that. So maybe they approach a Salesforce, a Google, a Microsoft to say, hey, Docusign, we are for sale. You got the speculative juices going clearly in the stock market. Now might be a good time to get out, especially because you're looking at a business that, has struggled with profitability. Only recently in the last few quarters, you see a very low profit margin. And maybe if it's owned, with someone like a Salesforce, maybe it's an Oracle, someone comes in and says, hey, we can start over from day one and say our expense structures just could be completely different and have much higher margins. This chart, by the way, is from AI Ticker Chat, which now has a series of free features. Anyone can check it out, that like for historic financials, as well as insider transactions. You can once again see that at AI Ticker Chat as well. And, it's interesting to me, and this what puts me in the little doubtful camp. I mean, maybe the sale occurs just because when you see an insider selling tens of millions of dollars of stock, and this is one of the directors, it makes you think like, and keep in mind, this was at lower prices than where Docusign is today. It does make me wonder, like, if it's really likely that a deal occurs, because generally insiders know, hey, this company might be for sale in the next few months, in which case you don't sell, you don't unload tens of millions of dollars in stock. And, it's spread across, a couple of different insiders, which makes me think this process must be either very new or unlikely to actually happen. So we'll see what happens. And, another perspective. So the Federal Reserve sees the stock market ripping higher based on, they're saying, hey, there might be cuts next year. And so now today they're like, whoa, hold on a second. We're not really talking about rate cuts right now. Like, we need to see, inflation go well below that 2%. We need to make sure we're really there yet. So what are all my thoughts as we're looking at these various different data points? You have the speculative juices, you have companies trying to sell themselves, the Federal Reserve. First of all, in full disclosure, this is not financial advice. Also, quick plug at Unrivaled Investing. My goal is to help everyday investors by identifying companies with compelling long-term business prospects, attractive valuations, and aligned management teams. I'm looking for companies that I can partner with and hold for years with the prospect of hundreds of % upside. I share my personal investment journey in a weekly letter at unrivaledinvesting.com if you'd like to learn more. So looking at the S&P 500 last 2 years, it is still not above its high. You are not talking about new high territory yet. When you see that, then I would be inclined to start believing, okay, maybe we are in this, grand new bull market when the S&P 500 clears its previous highs. But for now, I'm still looking at this thinking this is, it's not clear to me because it's not really coming from strong earnings growth that you're seeing this. You're still seeing an S&P 500 trading around 20 times plus earnings, and you're also seeing this rally occurring over the last few weeks in large part because interest rates, particularly long bond interest rates, have come back. And you can see how here's the 20-year Treasury bond ETF, TLT. It's been a complete disaster for the last few years as interest rates have moved higher. You can see that it rallied significantly in the last few weeks. I don't view this. I mean, you tell me when you look at this chart. I don't view this as a new necessarily bull trend where interest rates are, heading lower, where this is just going higher and higher, and as the price goes higher, interest rates go lower. I look at this and I'm saying it's not clear to me that that's a new trend. If anything, it might have been, it got, long-term bonds oversold and then they rebounded. I don't view this as, let's say, a new secular tailwind of lower interest rates going forward. You also consider what's going on with the U.S. government, with very high deficit spending, completely out of control, not really seeing any adults sort of say, hey, we need to manage our expenditures, we need to manage our budget. So that makes me think this is once again not going to be in some sort of bull market where you see favorable interest rates. Another key aspect, even if you have 3 rate cuts next year, you're talking about interest rates and cash going to between 4 and 5%. So, currently I keep my cash at Interactive Brokers, which yields over 4.8%. So if you do have those rate cuts, you're still in that 4% territory. So, in that environment, you're talking about risk assets that previously were being priced at 2 to 3% yields. You're still not having that tectonic shift, that dramatic change where you can say, oh, this risk asset should be back at a 3% yield. If you're at 4% cash, versus the 4.8% now, but let's say it goes down to 4% because the Federal Reserve has to lower rates because of a weak economy. So 4%, or because inflation is coming, significantly under control, or you're seeing even deflation. So 4%, that, would still justify in my mind saying, hey, you need to have 5, 6, 7% yields on risk assets, in which case it's still a major headwind on categories like real estate, which you're just starting to see the pain. It has taken months for this to get priced in. And I'd argue you're just starting to see that aspect where eventually home sellers are saying, hey, I got to sell. And, you bite the bullet on an 8% mortgage or a 6, 7% mortgage. I think you're just starting to see that dynamic. It's taken a long time, but I don't think that has been, that market event has not fully cleared yet. Correct me if you disagree in the comments below. Another key aspect for investors to consider, this from Larry Summers earlier today from the Financial Times. He makes a point like, look, at this point, we may have a soft landing on the aircraft carrier. We may have a hard landing and we may overfly it. Maybe the economy heats up real fast. This is a super important point for investors to consider. Understanding where a $20 trillion behemoth, a U.S. economy, predicting it, where it's going to go. Larry Summers, former Treasury Secretary, he nailed that inflation was real before a lot of people did. If he's saying it's very hard to predict where the economy is going to go, you might have a hard landing, you might perfectly land it, you might overshoot it. You might actually have this pickup where, inflation starts picking up again. If he's saying he can't see it with, perfect confidence, I think it's important for you as an investor to recognize the landscape is very, very murky. And so if it's murky, what do? What I'm personally doing is the same approach as always, focusing on one company at a time, thinking about their balance sheet. Will this balance sheet survive if there's a stressed economic environment? Do they have lots of cash, or do they have a lot of debt that's going to need to be refinanced? Do they have the income and the free cash flow to withstand a recession? Do they have, if you're looking at, let's say, the income statement, what are the underlying growth drivers that will propel this stock higher in the years ahead? Is this very likely? Is it obvious to me that this is going to happen? Or is this more speculative in nature, where it's going to require maybe some sort of favorable event to happen? So I think that's super important as you reflect on your own investing right now, to think about, okay, does this change my approach? If it does, it might be worthwhile reflecting on your approach. And if it doesn't change your approach, good, and reflect on, hey, what is that next great company that I'm going to buy where I think it's compelling, and thinking about that process. I hope this video has been helpful for you. Please make a point of hitting that thumbs up, hit that subscribe button. Thanks so much for tuning in to Unrivaled Investing.